Welcome to The Explainer. Today, we're going to build a really practical toolkit, one for digging into the risks of non-banking financial companies, or NBFCs. And by the end of this, you'll have a simple but, really powerful framework to help you make smarter and, frankly, safer investment decisions. So this is the question, isn't it? The one every single investor faces, especially when you're talking about the high reward but also super high risk world of NBFCs. Nailing the answer to this is absolutely the key to protecting your capital. All right, here's our game plan. We'll kick things off with a big NBFT puzzle itself. Then we're going to build our toolkit piece by piece, looking at leverage, these things called asset mismatches, and of course, funding sources. Then we'll put it all together. So let's jump right in. Okay, so first things first. Before we can even begin to assess risk, we really have to get our heads around the fundamental nature of the NBFC business model. You got to understand what makes it such a unique puzzle. It really all boils down to one core difference. See, banks, they fund themselves with our stable, low-cost deposits. NBFCs, on the other hand, they have to go out and borrow their money from the open market. And that reliance on market funding, coupled with, let's say, lighter regulations, well, that's what creates both their biggest risk and their biggest opportunity for profit. So how do we actually go about measuring that risk? Well, our first tool, and I'd say it's the most critical one, is all about decoding their use of leverage. Put simply, leverage is just debt. That's all it is. And since NBFCs use borrowed cash to fuel all their growth, understanding exactly how much they're using, that's step one. It's fundamental to assessing their financial stability. So what's a safe level of debt anyway? It helps to think of it in like three zones. A debt-to-equity ratio below 4-to-1, that's pretty conservative. But once you start seeing it creep past 7-to-1, you're looking at a company that is definitely taking on some significant risk. And here are the specific numbers for your toolkit. So while a healthy debt-to-equity ratio is somewhere in that 4-to-6 range, the real red flag, the one you've got to watch, is interest coverage. If a company's ability to just pay the interest on its debt drops below 1.5 times what it's earning, it could be in some very serious trouble. Okay, so moving on from just the amount of debt, our second tool looks at its timing. Now, this risk is a bit more subtle, but believe me, it can be just as dangerous. Let's talk about the mismatch trap. Asset-Liability Mismatch, or ALM for short, is a classic financial trap. I want you to imagine trying to pay your short-term credit card bill with money from a long-term investment that you can't touch for years. That timing problem, it can create a sudden, massive cash crunch. And it's the exact same principle for an NBFC. So while there are a few flavors of this mismatch risk, the one to really zero in on is maturity risk. This is that classic trap. Borrowing money for the short term, say 1 or 2 years, but using it to fund loans that won't get paid back for maybe 5 or even 10 years. To spot this, you have to dig into their financial reports and look for something called the maturity bucket analysis. Our third tool is all about a really simple but powerful idea. Follow the money. Seriously, because where an NBFC gets its funding from tells you a huge amount about how stable it really is. Now, a typical funding mix might look something like this, right? Money coming in from bank loans, bonds, all sorts of sources. But here's the thing, the numbers themselves don't tell the whole story. The real risk is kind of hidden. It's in the concentration of these sources. And here is your cheat sheet for funding risk. A major red flag is concentration. If more than 60% of their funding is coming from just one source, or even worse, if its top 5 lenders account for over 70% of its money, well, that company is in a very, very fragile position. So you've got the tools now. You can analyze leverage, you can look for that mismatch trap, you can check their funding. Now, how do you actually put them to work? Well, you do it by simulating a crisis. You run a stress test. And this, right here, is what separates being a reactive investor from a proactive one. It's just not enough to know how a company's doing today. You have to test its resilience against future shocks. Think a recession or a sudden spike in interest rates. That's exactly what a stress test is for. The professional approach here is very methodical. First, you define a realistic crisis. Then you calculate the financial damage. But the next steps are the crucial ones. Check if the company actually has enough capital to absorb that loss, enough liquidity to keep paying its bills, and, importantly, a credible plan to recover. Look at this. Under severe stress, a perfectly healthy company's numbers can just collapse. A capital adequacy ratio that looked great can suddenly fall below the required minimum. The percentage of bad loans can more than double. This is the hidden vulnerability that a stress test is designed to uncover. Okay, so we've built the toolkit, we've stress tested the system. Now, let's put it all together. Let's assemble your final risk playbook so you know exactly what to look for and what to do. These are the absolute deal breakers. You should treat these like blaring sirens on your investor dashboard. If you see any of these conditions, and especially those first 3 financial metrics we just talked about, it's a massive signal to proceed with extreme caution. Or maybe not at all. Look, if you remember only one number from this whole explainer, make it this one. Over 10 to 1. This isn't just high risk. This is a critical, blinking red light, a warning sign of potential instability. So what's the big strategy here? Remember that risk is never a static thing. It's always changing. You have to look at all these factors, leverage, mismatches, funding, all together, and you have to do it continuously. This isn't about a one-time checkup. It's about building yourself an early warning system so you don't get caught by surprise. And there you have it, your complete toolkit. You're now equipped to go way beyond just chasing returns and to start truly understanding the risk you're taking on. The real power isn't just in finding the next big thing, but in knowing which ticking time bombs to avoid. So the only question left is, which opportunity will you analyze first?